So good afternoon, everyone. Welcome to the class on investment management. So we were discussing about risk and return in the previous class. We did numericals also to calculate risk and return on a single asset or to calculate the risk and return on portfolio of assets. So in that sequence, let's discuss a problem which came last year for your senior, the case study. You can see this case study. So there's a stock of TCS, this stock of Tata company. It performed well relative to the other stock during the recessionary period. The stock of Wipro, on the other hand, does well during growth period. So there are two stocks are there, Tata and Wipro. So Tata did well during the time of recession, while Wipro normally does well during the growth time. So both the stocks are currently selling for 50 rupees per share. Both the stocks are currently selling for 50 rupees per share. The rupees return, dividend plus price change. So here they're talking about the return what you get on the stocks. So they're considering both the forms of return. Either I talk about dividend yield, either I talk about price appreciation. So whenever you do investment in stock market, normally to talking about the return on stock, whenever I talk about the return on a stock, so the return on stock I can get in two forms. So one form of getting the return is called dividend yield. Okay, there's a one form of getting the return is dividend yield, and the other form of getting the return is the price appreciation. Price appreciation. So there are many investors who when they do investment in the market, they are not looking for dividends. They're looking for price appreciation, because if the company gives dividend, then ultimately they are reducing the possibility of growth of the company. Because when you talk about growth, when you talk about a growth, so when you talk about the growth, the formula of growth is return on equity into retention ratio. This is the formula of growth rate. So this is the formula of growth rate. So if I talk about growth rate, so then the formula of that is return on equity into retention ratio. What is basically retention ratio? What is basically is your retention ratio? Retention ratio is basically a retained earning. Retention ratio is basically retained earning divided by profit after tax. So whatever the earning, whatever the profit, the net profit what the company get at the end of the day, so some part of the profit they give as a dividend to the shareholder, and the remaining part of the profit which they will not give to the dividend to the shareholder, because payment of dividend is not a compulsion for the company. For the preference shareholder, the company gives dividend, while for the ordinary shareholder, payment of dividend is not the compulsion for the company. If the company want certain time during festival time, or maybe other, maybe there's some negative rumor spreading about the company in the market, and maybe because of that reason the price of the share of the company is falling down. So just to attract investor, just to create a feel good factor, normally that time only in India the companies offers dividend to the shareholder. Payment of dividend is not at all a compulsion for the company to the ordinary shareholder. So always remember, whenever we talk about dividend, we should always remember that dividend is always, whenever we talk about dividend, we should always remember that the dividend is always calculated on face value. So when you talk about dividend, we should know that dividend is always calculated on the face value. So you should know that face value. What is the face value? So face value is the term which comes in picture whenever the company come up with an IPO. So whenever the company come up with an IPO, like recently this Burger King, so they are coming with the IPO. If you want, you can read about the IPO of Burger King. Is this good, really good to invest some money on Burger King or not? So basically face value basically means face value is more dominant term in debt market, because debt instruments are redeemable instrument, preference shares are redeemable instruments, but ordinary shares are irredeemable instrument. They follow going concern concept. So face value is the value what the company will give back to the shareholder when the instrument will mature, because in ordinary share, the shares will not get mature till the time the company does not file for bankruptcy. So the concept of face value does not become much relevant here. But you just remember, if you read the offer document or other information about the company, and if you see that dividend is given, and they will definitely mention the percentage of dividend what they have given to the shareholder. So there, don't get confused. Understand it is always calculated on face value. So normally the face value is always 10 rupees. Imagine if the company has given maybe a 5 rupees dividend, so they will tell that we have paid a dividend percentage of 50%. So don't go with that market gimmicks. Okay, so when we talk about growth rate, the formula of growth rate is retention ratio into return on equity. What is return on equity? The formula of return on equity is return on equity, means profit after tax divided by equity. What is equity? What is the equity of the company? Equity of the company is basically net worth of the company. So whenever we say equity, what is basically the equity of the company? We say it is a net worth. Net worth in balance sheet, we can see the net worth of the company. So it's good. So it's always good for the company that if they will not give dividend to the shareholder, if they retain the dividend to the shareholder, ultimately that would be kept as a retained earning, and continuous accumulation of retained earning will give reserve and surplus, and that reserve and surplus will ultimately increase the balance sheet of the company. Because when you see the balance sheet of the company, the two parts of balance sheet is there. So left hand side you have assets, right hand side you have liabilities, and the equity. So the equity is called as a net worth. So this continuous increase of retained earning or retention ratio is good for the company in the long run. But having too much reserve and surplus is also not good for the company in the long run, because there's something called inflation which reduce the value of money. So you should understand these terminologies. So whenever we talk about the return on equity, we use these two formula. One formula is dividend yield, and the another formula is price appreciation. So what is basically a dividend yield? What is basically a dividend yield? Whenever we talk about dividend yield is basically the total dividend paid in a year. Total dividend paid in a year. Total dividend paid in a year, divide by the total dividend paid by the company in the year, divide by the average market price. Average market price. Many people divide this by the current market price, or I can take average market price of last 1 year. Anything I can do, and I can multiply this with 100. If I multiply this with 100, I get the percentage of return what you get in the form of when you have done investment in the stock. When you talk about price appreciation, what is basically a price appreciation? When you talk about price appreciation here price appreciation basically means P2 minus P1 divided by P1 into 100. So P2 minus P1 means the P1 is the price at which you bought the stock. P2 is the price which it become in the future. So suppose you bought a stock when the stock was 100 rupees, and now today it becomes 150 rupees. So how much percentage of return you earned? That percentage of return you earned is 150 minus 100 divided by 100 into 100. So you got 50% return. So this is the percentage of return what you earn. So basically, when we talk about the return on stock, that is basically dividend yield plus price appreciation. And so once you get this price appreciation, you add this price appreciation with the dividend yield, and that will give you the sum total of all the return on the stock. So that you can understand from there. So there are two companies are there, Tata and Wipro. So Tata did well during the time of crisis or recession time when the market is not performing well, while the Wipro do well whenever there is growth time. So possibly I believe that the beta of the Tata would be less than 1, while the beta of the Wipro would be more than 1. Beta, what is beta? Beta is the sensitiveness of the stock with respect to the market. So how sensitive is the stock? Beta of the stock, if it more than 1, then definitely the stock will perform better than the market. So the volatility what we see on the stock is much more than the market. while so these both these stocks are available for 50 rupees per share. Okay, and then it is given that the rupees return is given for the stock and the probability is given to you, and the return, both their returns are given to you for the different time period. So then the question is that calculate the expected return and the standard deviation. So when you talk about, if the data is given in the term of probability, if the data is given if the data is given in the term of probability, if the data is given in the term probability, if the data is given in the term of probability, so how to find the expected return? So how to find the expected return? So the expected return formula is sum of EI, right? That is the expected return. So that is the expected return. So how to find the standard deviation? So the standard deviation is the factor which measures the risk on the investment. So the standard deviation, the formula for the standard deviation is there in the square root summation of EI into RX minus ERX, where this is the ERX, which is expected return whole square. This is the formula of standard deviations of what may be supposed stock X. Now, if I ask you what is the covariance between stock X and Y, that is EI summation of EI RX minus ER into RY minus ER. This is a formula of covariance. So you understood the formula. What is the formula of expected return? What is the formula of standard deviation? What is the formula of covariance? So you can do that. So this is the formula. So covariance is the mutual attraction or repulsion between the two individual variables whenever they obtain together. That is called covariance. So here, so in this question, when you see, uh, so what I can do there, like if you see in this question, both the stocks are selling for 50 rupees each. Calculate the expected return and standard deviation for 1,000 rupees invested in the equity stock of Tata company. That is the first question. Question number two, 1,000 rupees invested in the equity stock of Wipro company. Question number three is there. 500 rupees invested in Tata, 500 rupees in Wipro. So means 50-50%. Question number four is there, 700 in Tata, 300 in Wipro, means 70 and 30%. So then you can find that. So you know how to do the calculation. So let me write it down. So probability return on Tata, return on Wipro, probability is given to you 0.3, 0.3, 0.2, 0.2. Return on Tata 55. So all data is in percentage, although they are not given, but understand 10 percentage. This is 60. This is 70. This is 75, 65, 50, 40. So understand this. Okay, so we can find the expected return. So to find the expected return, we can find the expected return. We can find the expected return on Tata. So the expected return on Tata. Then I can find the expected return on Wipro. So I can find the expected return on Tata, expected return on Wipro. So this is probability into the individual return multiply. So you know how to find the expected return. 0.3 into 55. So you'll get 16.5. Then what you'll do after that, zero point 0.3 into 55, that is 16.5. Then zero point 0.3 into 50, you'll get 15. 0.2 into 60, you'll get 12. 0.2 into 17, 70, you will get 14. So so sum of this is the expected return. So what is the formula of expected return? I'll write this as like this. So this is basically expected return. So the expected return is the sum of this. The same thing I'll do it here. The same thing I'll do for Wipro. The same thing I'll do for Wipro. So this is so you can find the expected return of Tata, expected return of Wipro. So the expected return of Wipro, what you did do, zero point 0.3 into 75. 0.3 into 75 is 22.5. 0.3 into 65 is 19.5. Okay, everyone, anyone have doubt? 0.2 into 50 is 10. Okay, so then zero point 0.2 into 40 is 8. Sum total of this, so 57.5. So you got the expected return. So the expected return of these are the expected return. So you got the expected return. You got the expected return of Tata. You got the expected return of Wipro. So once you get the expected return, so if imagine, so question number one. So if so here, imagine if I invest 100% of money in Tata, then if I invest the question number one, what is the expected return? If I put 100% of money in Tata, then my expected return would be 57.5%. While if I put 100% of money in Wipro, 100% of money means 1,000 rupees. If I put my 1,000 rupees in Tata, then I'll get a return of 57.5. While if I invest my 100% of money in Wipro, then I'll get a return of 60%. Now, if you want, so now what I can do once I get this, so for Tata, I can find for Tata what I can do for Tata. For Tata, I can find RX minus ERX. Then for Tata, then for Tata, I'll find RX minus ERX whole square. Then for Tata, I'll find RX minus ERX. Suppose Tata is X and Wipro is Y. And then I find Rx minus ERX whole square for Tata. I'll multiply that with probability. I'll multiply that with probability for Tata. So Pi into Rx minus ERX whole square. So that I'll do for Tata. So so Rx is what? This is return. This is this minus expected return. What is the expected return? What is the expected return of Tata? This is the expected return of Tata. So to subtract that, that I can find. I can find the expected return minus expected return of Tata. Then I can do the square of this. Then I can do the square of this, then I can do the square of this, get this value. If you do the square, you can do this all these calculation by using calculator, but unnecessary is very time consuming. So I 2.5 square, writing 7.5 square, 12.5 square. So better I'm by using Excel, I'm getting the answer very fast. So at least I'm saving my time. That the same kind of steps, why to waste time doing calculator? So probability into Rx minus Ex square. I did this. I can do for all stocks. Okay, so the what is the standard deviation? So the standard deviation of Tata is 51.25. This is the variance, sorry. This is not the standard deviation, this is the variance. So this is the variance. So the sum of, you know, the formula that the variance that the, if you want standard deviation, so the standard deviation of Tata, if I want, that would be square root of 51.25. That would be the answer. What is the square root of 51.25? The square root of 51.25, that is 7.15. That is the standard deviation of the Tata. This is the standard deviation of Tata. The same process what I did for Tata, the same thing I have to do for Wipro. The standard deviation of Tata is this much. So standard deviation, when you say the Tata, when I say Tata, if I put my 100% of money, my 100% of money means 1,000 rupees on Tata. So then I'll get a return. Then my return, is equal to, 57.5, and my risk is equal to, so standard deviation is risk 7.1589. That is 7.1589. That will be somewhere like this much. So if I put my 100% of money in Tata, so so my return would be 57.5%, while my risk would be 7.1589%. Anyone have any doubt? Anyone have any doubt till now? Simple formula, you know the formula of standard deviation. This is the formula of standard deviation. So I use this formula of standard deviation, and I can find the standard deviation of the returns what is given for the Tata and Wipro. Okay, I can find the expected return by using this formula. Okay, so I can find the expected return by using this formula. So you can find the expected return, you can find the standard deviations and all. So the standard deviation is the factor which talks about the risk, while expected return is the factor which talks about the return. Everyone, so that is basic understanding what we need to develop. How to calculate the return? How to calculate the return? So return already I explained you this now. So return. So yes. So that in the question it is not given. So in the question it is like considered that return what is given is the sum total of the return given for dividend and the price appreciation. So that compute both. So dividend yield also and price appreciation also. Okay, everyone. So I hope you are understanding. Anyone have any doubt? Any question you want to ask? Anyone, any question you want to ask? So the way we did for Tata, the same way we'll do for Wipro also. So the same way we'll do for Wipro. So now, I'll write for Wipro the same thing. So this is RY minus ERY. This is for Wipro. The same thing I'll write for Wipro. Then I'll do the square. Then I'll do the square. Then RY, and Y means Wipro. X was Tata. RY minus ERY whole square. Then I'll multiply that with probability. So I'll multiply this with probability. So Pi into Ry minus ERY whole square. So Wipro, the same thing will do Ry. So the return, what is the return on Wipro? This is the return on Wipro. This minus the expected return. What is the expected return? This is the expected return. So return minus expected return. So one by one you can do 75 minus 60, 65 minus 60, 50 minus 60, 40 minus 30, 60 that you can do manually that work. Then this square of this, then multiply with probability. So you multiply this with probability. So if you multiply with probability, everything. So you got this. Now what is the standard deviation of Wipro? So the standard deviation of Wipro is the square root of 175. 175 is nothing but it is the summation of Pi into Ry minus ERY whole square. So this is 175. This is the standard deviation of the Wipro. So this is the standard deviation of the return of the Wipro what you got. So what is the standard deviation of Wipro? That is equal to the square root of 175. That is 13.228. 13.228. So 13.228. So Wipro, if you put 100% of money, means 1,000 rupees, then the return what you're getting, return percentage what you're getting, the return percentage what you're getting on Wipro, what is the expected return? Wipro, the expected return is 60. Wipro, the expected return is 60, and their risk risk is how much? So the risk of Wipro is 13.228. So this is 13.228 percentage. Okay, so we got the answer for the first two part. This is lengthy question. So this is a lengthy question. So we got the answer for the first two part. So anyone have any doubt? Any doubt till now? So 1,000 rupees. If 1,000 rupees, if I put my Tata, this would be my return. This would be my risk. Wipro, 100% of money if I put, this would be my return. This would be my risk. Okay, so 1,000 rupees invested in Tata, 4 marks. You will get this much. So till now, whatever I've done, you will get 8 marks for that. The calculation what we did, so we got 8 marks for this. So this is actually 16 marks question. Correct? 16 or yeah, 16 marks question. So we'll continue this in our next class. So till this much we have done in this class. We'll continue discussion in next class. Till now, anyone have any doubt? So simple formula is there for expected return. What is the formula of expected return? We know the formula for the expected return. So we know the formula of expected return. That is summation of Pi into Ri. We know the formula of standard deviation. So whenever probability is given, we use formula for the standard deviation. And if covariance we have to determine between x and y, we use this formula. So anyone have any doubt? Any doubt, anyone?